Wall Street's hot streak continued today, showing no signs of slowing down. The S&P 500, Dow Jones Industrial Average and Nasdaq Composite all closed in positive territory, reflecting strong investor confidence. This marks the 7th consecutive winning session for the market, a streak that has investors and analysts buzzing. The S&P 500 even reached a new all-time high, breaking previous records and setting a new benchmark. Investors seem optimistic about another potential rate cut by the Federal Reserve, which could further fuel the market's upward trajectory. However, it wasn't all smooth sailing today. Concerns about potential new tariffs introduced some volatility into the market, causing brief moments of uncertainty. President-elect Trump's comments on imposing tariffs on imports from Mexico, Canada, and China caused some jitters among traders and investors. Despite this, the overall sentiment remained positive, with many believing that the market's fundamentals are strong. The market seems to be brushing off any negative news, focusing instead on the potential for future gains. Hopes of a rate cut and the strong performance of mega-cap stocks are driving the upward momentum, creating a sense of optimism. It remains to be seen if this bullish trend can be sustained in the long run, as market conditions can change rapidly. Tomorrow's inflation report will be crucial in determining the market's direction, providing insight into economic stability. Investors will be eagerly awaiting the October Personal Consumption Expenditure, or PCE, price index data, which could influence future market movements and Federal Reserve decisions. Mega-cap stocks stole the show today, capturing the attention of investors and analysts alike. Apple, Meta Platforms, Alphabet, and Microsoft all rebounded strongly, showcasing their resilience in a volatile market. This came after these giants had taken a backseat to smaller companies in recent sessions, which had been leading the charge. Even the struggling Nvidia managed a late surge, surprising many who had written it off. The resurgence of these heavyweights provided a significant boost to the major indices, lifting the overall market sentiment. Their strong performance helped to offset some of the losses experienced by other sectors, which had been dragging the market down. The reasons behind the mega-cap rally are multifaceted and complex. Some analysts believe that investors are seeking refuge in these perceived safe havens amid tariff uncertainties and global economic concerns. Others attribute it to their strong earnings potential, robust balance sheets, and overall market dominance. Whatever the reason, the performance of mega-cap stocks will continue to be a major factor in shaping market sentiment and investor confidence. Their influence on the broader market cannot be overstated, as they play a crucial role in driving market trends and investor behavior. President-elect Trump's comments on tariffs added a layer of complexity to the market's narrative. He reiterated his commitment to imposing new tariffs on imports from Mexico and Canada. Additionally, he pledged to increase tariffs on goods from China. These pronouncements sent ripples through various sectors. Companies with significant international exposure, particularly those operating in Asia, faced immediate pressure. Shares of semiconductor, energy, retail, manufacturing, and auto firms dipped. The market's reaction was swift, but it remains to be seen how these tariff threats will translate into actual policies. Investors are cautiously optimistic that any potential trade disputes will be resolved amicably. The uncertainty surrounding this issue is likely to persist in the near term. Section 4. Yield curve sends mixed signals. The yield curve, a key indicator of economic health, presented a mixed bag today. The 10-year Treasury note yield, a benchmark for long-term interest rates, rose by 4 basis points. This uptick was attributed to Trump's tariff comments. However, shorter-term yields moved in the opposite direction. They declined following the release of the Federal Reserve's latest minutes. The minutes were interpreted as dovish, suggesting a willingness to maintain or even lower interest rates. This divergence in yield movements kept the yield curve slightly inverted. An inverted yield curve, where short-term rates are higher than long-term rates, is often seen as a harbinger of economic recession. Section 5. Inflation fears simmer. Despite the positive market sentiment, inflation concerns haven't completely dissipated. Investors are eagerly awaiting tomorrow's release of the October Personal Consumption Expenditure (PCE) price index report. The PCE is the Federal Reserve's preferred inflation gauge, A higher than expected PCE reading could reignite fears of inflation. This could potentially prompt the Federal Reserve to reconsider its stance on interest rates. Conversely, a benign inflation report would likely reinforce the current market optimism. The PCE report is just one data point in a complex economic landscape. However, its significance in shaping market expectations cannot be overstated. Section 6. Breadth divergence raises eyebrows. While the major indices painted a rosy picture, a closer look at market breadth reveals a different story. 2 out of every 3 stocks traded on the New York Stock Exchange, NYSE, closed lower today. This stark contrast to the performance of the major indices highlights a potential divergence in market sentiment. This divergence suggests that the market rally may be narrower than it appears. The strong performance of mega-cap stocks is masking weakness in a significant portion of the market, and this raises concerns about the sustainability of the current upward trend. Market breadth is an important indicator to monitor. It provides a more comprehensive view of market sentiment beyond the headline-grabbing performance of major indices. Section 7. Sector Roundup, Winners and Losers. In this segment, we delve into the performance of various sectors and identify the key players who emerged as winners and those who faced significant challenges. The performance across different sectors was mixed, reflecting the complex and often unpredictable nature of the market. Companies with international exposure faced headwinds due to tariff concerns, which created an uncertain business environment and affected their bottom lines. The energy sector also slipped as crude oil prices declined on news of a ceasefire in Lebanon. This geopolitical development led to a temporary reduction in oil demand. On the flip side, utilities emerged as winners, benefiting from the market's shift towards more stable and reliable investments. This was partly attributed to the drop in treasury yields, which made utility stocks more appealing. Lower yields make utility stocks, known for their stable dividends, more attractive to income-seeking investors. These stocks provide a steady income stream, which is particularly appealing in times of economic uncertainty. Retailers Best Buy and Kohl's both experienced significant declines after reporting disappointing earnings results. Their performance underscores the ongoing struggles within the retail sector. Their struggles highlight the challenges faced by traditional brick-and-mortar retailers in the age of e-commerce, where online shopping continues to dominate consumer behavior. Zoom, the video conferencing giant, also saw its shares decline despite exceeding earnings expectations. This decline was surprising to many investors. The decline was attributed to profit-taking after a stellar year for the company's stock, indicating that investors were locking in gains. Overall, the sector performance underscores the importance of diversification. Diversifying investments across various sectors can help manage risk. A well-diversified portfolio can help mitigate risks and enhance returns in a volatile market environment. Investors are advised to consider a balanced approach to navigate the complexities of the market.